Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Hello, everyone. Welcome back to another episode of Blind Spots. In today's podcast, we are going to be talking more about retirement problems. In our last episode, we identified all of the problems that retirees are facing throughout retirement, and it may have come as a surprise, but there are many other problems that retirees face that come ahead of financial difficulties. So just as a reminder, some of those were things like loss of identity, lack of routine, lack of friends, lack of community, watching too much TV, and all of that came ahead of financial difficulties. It's kind of the softer side of things. So in today's episode, we are going to be talking about the top financial difficulties that we see retirees facing. Nick, if you were to retire today, what do you think your number one retirement problem would be?
Do I have enough money? I think that's the universal overarching issue that a lot of folks want to know. And it's completely valid.
Yeah. We always say that the day you retire is the day that your money needs to last the longest. And so I think worrying about running out of money is validly at the top of the list.
Well, and there's also a softer side to it. It's a change from having a income not tied to financial markets. You know what you're going to get roughly, assuming you have a fixed salary, to going from not having that safety net. And I think that it brings out a lot of emotions and feelings like, oh man, this is my pot of money. This is all I have. I can't ride down the valleys in the market anymore. There's things I want to do. I need to spend money. I still have bills. So it's kind of a cocktail, and it all stems from the desire of wanting to know if you're going to be okay.
Yeah. Okay. So let's just run through our list here of retirement problems that we see on the financial side of things. And let's start at the top with worrying about running out of money.
Yeah. And I think the biggest thing with that question, including all the things I just said, is a lot of folks get distracted with the daily ebbs and flows of the market, which certainly are a variable when you're trying to answer the question if you have enough money or not. But also a blind spot that we've seen more often than not is not having a good handle on what's going out the door, what your expenses are. And markets are external factors, an external factor that you cannot control. What you spend on a monthly basis is something that you very much can control. And it's not like, we're telling people not to spend money, but certainly you need to know where your baseline is.
Yeah, your expenses are one of the biggest factors in, I think, a successful retirement, because that can make or break a plan. Even sometimes what seems like a small change in expenses, call it $1,000 a month, for example, higher could put a plan that was successful on the rails. And I think that's an eye-opening scenario that we run for clients, is higher expenses.
Well, and more importantly, it's something that you have tangible control over. Like you can you can very much control what you're spending. Sure, there's one-off expenses, but if we're running a plan for the next 20 years, we have a greater amount of control of what we spend versus what the market does, let's say. So kind of the overarching theme of what we do at Pure is to turn the lens inward and to focus on all the things that we can control. Our monthly spend, our taxes, our emotions, the financial planning process, how much risk that we're taking. And when you do that, it can give you confidence that you're optimizing the things that are within your reach.
In addition to worrying about money, that's the number one question or worry that we get from clients. Close to the top, if not second, is paying too much in taxes. A lot of people are just worried about taxes.
And again, this goes back to my opening comment where if you're employed, your check comes in, you know how much the feds are taking. If you live in an income tax state, you know how much the state of Oregon is going to take. When you retire, it's not so obvious. You might have a pension, you might have an annuity, you've got Social Security, You've got an IRA, a Roth, a after-tax account. Taxes are as clear as mud. And what we like to say is everyone has to pay taxes. No one says you have to leave a tip. So part of what we do and what Aaron does every day is just modeling the most tax efficient way to get money to you. Sometimes it's obvious, sometimes it's not so obvious. But again, when we talk about focusing on the things that you can control, building a tax efficient investment portfolio, having a program that reduces or mitigates taxes if you need income from your portfolio, this is all the low hanging fruit that we can help you unpack.
And a lot of people say that you don't have control over taxes, and that's true in some ways. A popular topic now and coming up over the next couple of years is the Tax Cuts and Jobs Act that is set to expire at the end of 2025. So there potentially could be some higher taxes coming back our way. But there are things that we can control. So one of those things is that if you are still in wealth building mode, if you're still pre-retirement, having options in terms of taxes is a great way to set you up for success. So one way that you can do that is in addition to contributing to your 401k, if you have that available at work, you can also make Roth or after-tax contributions. If you have excess money, you can also put that into a taxable account. So having different tax treatments of different accounts once you reach retirement gives you options in terms of where you pull that money from and how much taxes you are paying on that income.
Right. So that's on the planning side. That's Aaron's neighborhood. On my side, on the investment side, there's certain flagrant fouls that I see all the time, either from do-it-yourself investors or folks working with an advisor. And I'll just rattle off them very quickly. I've got blogs and podcasts about all these things. Targeting dividend income or income strategies in a non-retirement account. Dividends aren't the worst sin. They're not even a sin. But if you're targeting income-related strategies in a non-retirement account, there's no way to shelter dividend income from taxes. So own dividend stocks, own them in a more tax-friendly account. Okay. Owning mutual funds in a non-retirement account. A lot of these mutual funds have managers that are buying and selling stocks or bonds or what have you. They're passing along capital gains to you at the end of the year, and you've done nothing but own their fund. So if you own mutual funds in a taxable account, regardless of the merits of that mutual fund, if it's done well, if it's done okay, if it's done poorly, know that you're probably lighting money on fire each year in the form of capital gains taxes. So those are probably the two biggest mistakes that I see. And again, it takes zero talent to put those in a more friendly account. It takes zero opinion on what the market does next. It's just, again, harvesting the low-hanging fruit and maximizing your net after-tax returns.
The last thing that I'll say on taxes is that knowledge is power. I think a lot of people may go into retirement blind, and there's a lot of really high level things that most people don't want to understand. Taxes being probably close to the top of the list, that, like you said, it's clear as mud. But sitting down and understanding where income is coming from, how it's taxed, how your investment portfolio is going to generate income is really important. And so having a trusted professional to help you with that, I think, puts you ahead of the game just to help find opportunities to save on taxes.
Well, and the last thing I'll say, and this is more relevant in the last year and a half as the Fed has raised rates, like back in 2016, let's say, generating investment income or taxable investment income was really not a thing unless you were in some exotic strategies. So folks didn't really have to worry about it. But now investment portfolios are spinning off meaningful income. And if you're not intentional about the way you think about income in your investment portfolio, you're going to be siphoning off money and leaving a tip to Uncle Sam when you didn't have to.
That's right. I think it's kind of an interesting industry to be a part of, whether you're new into the game or not. Like for someone who's retired in the last 10 years or so, let's say, generating portfolio income is probably going to be new for them. And whether your advisor is new or not, you're either learning these new strategies or you're brushing up on these old strategies. So it's kind of, I don't know, I'm having fun. I don't know about you.
This is, I mean, I've said this before.
Yeah.
This period is going to be talked about for 100 years in academics and textbooks, just as a case study of randomness and a regime change, really. Everything we've known to be true the last 10 years, low rates, low inflation, stocks only go up, global peace. I mean, I throw that out there, but like a non-wartime has all been flipped on its head. And, you throw in politics, the polarization of that dumpster fire, and a pandemic. So there's so many things that we're piling on that this is just not a normal business environment. So again, I keep saying this, but these are all things that people worry about that they can't control. And the more you focus on external factors, that's energy that you could use to clean up your side of the street. Like we always talk about at Pure, keeping your side of the street clean. If you're focused on other things, you're taking energy away from what you can control.
Okay, that's enough on taxes.
That's enough for me.
Going back to the expense side of things, another big concern for retirees is unknown future expenses, especially where healthcare is concerned and potentially assisted living. So do you want to talk more about that?
Yeah, look, the last 3 years has taught us your plan is not going to go according to plan. I've said that a lot. I think it's true, or I wouldn't say it. So our goal is not to have you on this razor thin line between success and failure. It's to build a margin of safety, right? So when things get weird, when markets go down, when inflation goes up, when life happens to you, one bad break doesn't derail your plan. And we do that in several ways. One is being aggressive on the expense side. So let's say you want to throw in a travel budget in your financial plan and you think it's going to be 25 grand a year. We might turn that up to 35 grand a year. All right. Let's say you retire at age 50 and the market has done 8% on average a year. Well, we're going to model 4.5%. Okay. And we'll do this over and over and over again. And if your plan is favorable with conservative estimates on your asset side, on your income side, aggressive estimates on your expense side, that naturally builds in a margin of safety over time. And then on top of that, the second thing that we do is we stress test plans, right? So what if inflation is higher? What if you need extended care in old age? Then we'll model $80,000 a year. I'm just throwing numbers out. So we'll model that scenario to give you, again, a margin of safety, because nothing's made sense the last couple of years. Life happens, markets happen. You want that buffer just to make sure that you're not going to run out of money and things will be okay.
Yeah. In addition to that, or kind of on that same wavelength, another question that we often get is, when should I take Social Security? When should I start my pension? Et cetera, et cetera. And all of that can be answered through our financial planning process. It's an individual decision. There's a lot of moving pieces that can help define what the optimal solution is for you. So running different scenarios of taking Social Security at 65 versus 67 versus 70 can all be answered through your financial plan.
Well, and I think that's important because so many people want to make decisions in a silo. Like, should I take Social Security at 62 or 70? It's like, well, it depends on your expenses, depends on your portfolio assets, it depends on your tax picture, it depends on your health. So there's so many things that you can model, and we can actually model taking it at 62, taking it at 70. Know that you're making some assumptions in either case, but to provide context, we can run it side by side so you understand how, if you pull one lever, how does that affect everything else? And I think that's another common mistake is people making decisions in silos. You could be talking about an annuity, a pension, a Social Security question. Run everything in the context of your plan.
I think oftentimes people will look for black and white answers to everything, or an article that says you need this much to retire, or never wait until 70 to take Social Security, or always wait until 70 to take Social Security. But the reality is that everyone is so different. Even if you retire at the same age and you've had relatively the same kind of trajectory of a career, the two retirement plans are going to look entirely different.
Which is why your stock response when someone asks you a question like that is what?
It depends.
It depends, which seems like a cop-out.
It always sounds like such a cop-out. Yeah, it's horrible. I hate saying that, but everyone in life is looking for the magic pill, the quick answer, the fast route to success, and there just really is no easy one and done thing.
Well, that's
planning.
that's a human tendency. When things are super complex and outside of your sphere of influence, humans want mental shortcuts, which I talk about a lot in my blogs.
Yeah, that's what keeps our jobs around. So here we are.
Okay, so let's pause here. So the first one is potentially running out of money. That's worry number one.
Mhm.
Worry number two is
Paying too much in taxes,
paying too much in taxes. 3,
unknown healthcare or large expenses in the future.
and then the fourth.
Fourth is making decisions, Social Securities, pensions, annuities. What the heck works for my plan?
Okay. And is there one more?
It's not very specific, but we just talked about the overarching question is, given all of the things that I have going on, can I do what I want to do? Can I continue to live the lifestyle that I've been living pre-retirement, post-retirement? Do I have permission to spend money on XYZ?
This is what
And those are the questions that we help answer.
this is what I tell people when they say something like that. Model your dream retirement. Everything that you want to do, everything that you could possibly dream of. Let's model your ideal retirement. And let's say we run that and we're short, then we can start to scale back. But start with your absolute dream retirement scenario, and then we can work backwards from there.
Yeah, that's what I always say too, is we create your foundational financial plan, but put your best case scenario at it. If it works, awesome. We'll stress test the plan and find the breaking points. If it doesn't work, we're going to go back to the drawing board and see what needs to be changed or tweaked, whether that's working longer, making more, saving more, or changing goals. So
Right. And all of these worries stem from not having context, not understanding how one input impacts the other. So kind of our overarching advice to mitigate a lot of these fears and to give you confidence is to run it in your financial plan. Aaron can run scenarios. So like people come to us all the time. Hey, I'm thinking about buying a second home. I'm thinking about doing a Roth conversion. Well, let's run scenario A where you're doing nothing. So you're continuing on the plan that we built, on the course that we've built, versus modeling some of these other things, buying a second home, doing a Roth conversion. Let's run them side by side for 5 to 10 years and see the impact. Then you can see, oh, well, if I do a conversion, my taxes are going to go up. I need to pay for those taxes out of my portfolio. If we model a down market that year, that could put stress on my plan. So you start to build these scenarios and frame these outcomes. And look, like, we're not saying that you have to follow the advice, but money's emotional. There's all these external factors coming at you. There's people giving you advice. You're reading stuff on the internet. We want to give you information that's relevant to you to make the best decision for you and your family, stripping emotion out of the equation. Now it's up to you to implement. You can listen, you can not listen, but at least we've done our part to give you sound information.
yeah, we always say that we want to make data-backed decisions. And like you said, we can't implement it for you, but what we try to give is peace of mind so that you can make those decisions with confidence.
Okay, I think that's a wrap.
Okay, that is retirement problems and financial difficulties that retirees are facing. So if you have any questions or want to leave us a comment, you can reach out to us at insight@pureportfolios.com, and we will see you in the next one.